In this video, I'm going to talk about the financial statement of sole proprietorship in brief. At the end of every year, the accounts of the business have to be finalized. So in this case, a financial statement has to be prepared to finalize the accounts of the business at the end of every year. So in the case of a sole trader, the preparation of final account involves three things. That is, the first one is the preparation of trading account, then the second one is profit and loss account, and the last one is the balance sheet. So trading account and profit and loss account is also known as the income statement, which shows the operating results of the business at the end of an accounting period. And the balance sheet is also known as a position statement, which reflect the assets, the liabilities, and the capital of concern at a certain date. Now let's look at the objectives of preparation of a financial statement. So the first objective is to know the profitability of the business. The second one is knowing the solvency of the business, that is the ability of the business to pay to the outsiders liabilities. Then to judge the growth of the business, then judging the financial strength of the business. It helps in forecasting and preparation of budgets, and also to communicate the financial statement to the various interested parties of the business. The first component of the final account of a sole trader is a trading account. So a trading account helps in determining the gross profit or gross loss of a business concern. And to find out the gross profit or gross loss, only direct revenue and direct expenses are to be considered. And these direct expenses are the expenses relating to the procurement of goods, and the direct revenue is the sales of the finished goods which has been purchased, which are meant for resales. This is the format of a trading account. We'll have various items on the debit side, all the expenses, that is the direct expenses on the debit side, and we'll have the direct income on the credit side. And if the debit side is greater than the credit side, that'll be a gross loss. And if the credit side is greater than the debit side, that'll be your gross profit. And this gross profit or gross loss will be carried down to the profit and loss account. So the next one is the profit and loss account. So profit and loss account helps in determining the net profit or net loss of a business concern. So in a profit and loss account, only indirect revenue and indirect expenses are considered. And indirect expenses can be administrative expenses, selling and distribution expenses, and financial costs. And in case of indirect revenue, it can be rent received, commission received, then profit on sales of fixed assets, and so on and so forth. This is the format of profit and loss account. You will have on the debit side the various expenses and loss, then on the credit side we'll have the incomes and gain. If the debit side is greater than the credit side, that will be your net loss, and if the credit side is greater than the debit side, that will be your net profit. After the profit and loss account, we have the balance sheet. So the balance sheet is a statement of assets and liabilities. Then all assets and liabilities of the business are to be recorded in the balance sheet at the end of the accounting period. And it also shows the financial position of the business by detailing the source of funds and how the funds are being utilized. So that is how much capital do you have and how this capital are being utilized in the procurement of assets and also in the day-to-day functioning of the business, that is the working capital. There are two ways of arrangement of assets and liabilities in a balance sheet. The first one is in order of liquidity, where the assets are arranged in order of convertibility to cash and the liabilities are arranged in order to be discharged. Then the second one is in order of permanence. So assets are arranged starting from least realizable to most liquid, and liabilities are arranged in order of their permanence, that is liabilities to be discharged last is shown first. This is the format of the balance sheet in order of permanence. So it starts with capital and ends with sundry creditors. Then it starts with the fixed assets. It ends with the current assets, the most liquid one, that is the cash in hand. Then if the balance sheet has to be shown in order of liquidity, it will be the reverse of this format. Now we have the classification of expenditure. So there are three types of expenditure. The first one is capital expenditure, where the benefit out of this expenditure is more than one accounting period. So the best example of this type of expenditure is the procurement of fixed assets. Then we have the revenue expenditure, where the benefit does not extend more than 12 months, that is for one accounting period. And these type of expenses are mainly for the day-to-day functioning of the business. And the third one is the deferred revenue expenditure. So some revenue expenditure which are likely to give benefit for more than one accounting period are termed as deferred revenue expenditure. And the best example of this is the heavy advertisement expenditure, where the benefit from this expenditure is for more than one accounting period. There are two types of receipt. We have the first one, a capital receipt. That is, if the receipt implies an obligation to return the money, these are capital receipt. The examples are capital or additional capital, and loan taken from the bank. So both receipts are leading to obligation which have to be paid or which you have to return the money. And another example of capital receipt is the sales of fixed assets like old machine or furniture. Then the second one is revenue receipt. So if a receipt does not incur an obligation to return the money or it's not in the form of sales of fixed assets, then it's termed as revenue receipt. Now, why do you have to know about revenue receipt and revenue expenditure, capital receipt and capital expenditure? Because in a trading and profit and loss account, we have to consider only the revenue expenditure and revenue receipt. And in the balance sheet, you have to take the capital receipts and the capital expenditure. Then all outstanding and prepaid expenses and income will have to be adjusted accordingly. Then the treatment of outstanding and prepaid expenses in the financial statement. So in the case of outstanding expenses, if it appear in the trial balance, it will be shown at the liability side of the balance sheet. If it's given in the adjustment, that is the additional information, it will have two effects. It has to be added to the particular expenses either in the trading or profit and loss account. Then it has to be shown in the liability side of the balance sheet. Then in the case of prepaid expenses, if it appear in the trial balance, it will be shown in the asset side of the balance sheet. Then if it's given in the adjustment, then there will be two effects. First of all, you have to subtract from the particular expenses either in the trading or profit and loss account, then it'll be also shown in the asset side of the balance sheet. Next, we'll have the treatment of outstanding and prepaid income in the financial statement. So regarding outstanding income, if it appeared in a trial balance, it'll be shown in the asset side of the balance sheet. Then if it's given in the adjustment, we'll have two effects. It has to be added to the particular income either in the trading or profit and loss account, then it has to be shown in the asset side of the balance sheet. Then the case of prepaid income, if it's appeared in trial balance, be shown in the liability side of the balance sheet. Then if it's given in the additional information, it will be subtracted from the particular expenses either in the trading or profit and loss account, then be shown in the liability side of the balance sheet. So we have the various classification of assets. So assets are being classified into fixed assets, current assets, tangible assets, then intangible assets. Then we have fictitious assets and also wasting assets. Then the classification of liabilities, we have owner's capital, the long-term non-current liabilities, the current liabilities, and the contingent liabilities.